Welcome to the daily update where I'll go over the action in the market for Wednesday, October 9th, and then we'll see how things look for Thursday, October 10th. Hit a new all-time high with the S&P as well as the Dow. Some of our charts are showing a little bit of an improvement, but the warning signs that we were already seeing, especially as they applied to the VIX, they're still there. And so there were really no surprises that came out with the FOMC meeting minutes. The market decided to go higher. It kept those gains as we saw the release of the minutes and ended up just moving up. But we're still below average with volume, but we're still looking positive in the short, intermediate, and long term. But there's some warning signs, and we've got CPI coming out on Thursday. We'll see if the market has some kind of a reaction to that. There's a thing called the SPX Investing Program. It's the program that I have developed, and there are new people joining all the time there. And hopefully, you might want to check this out. There's a link that will take you to the website. There's a link that takes you to a video. You can email me a question. You do get immediate access to the videos once they are uploaded. Otherwise, I keep them from going public on YouTube and Rumble. So feel free to check that out and see if there's something that you find valuable with the program. Also, the daily video is the video that is the real foundation of the analysis and commentary that I do anyway. Then over the weekend is when I do all the weekly videos. All right, let's go back and talk about what happened. Had pretty much a flat open. The futures really weren't moving one way or the other. They were actually a little bit negative and started to become a little less negative as we got to the open. So it was pretty much flat. But then right after the open, we climbed above R1 at 57.68. We got above R2 at 57.84. And then we just chopped along R2, kind of a little bit above, a little bit below, and we were able to close above R2. We were up 0.71% on still below average volume, and this is a bit of a concern. We could kind of explain this over the summer months because of vacations and summertime and all of that, and the S&P was going up on below average volume, but everybody's supposed to be back at work now. Now, people are trying to outrun hurricanes or deal with the hurricane that's already hit. So, yeah, that can be explained a little bit there. But this is usually the time of the year when volume really starts to pick up. But we've been below average with volume now for a number of days. We are still positive in the short, intermediate, and long term, but there are some warning signs that we want to be aware of. It just seems like no matter what happens, we have this Hindenburg-Ullman, we have weak seasonality, at least historically. News comes out, interest rates going back up, the dollar's going up, but stocks just keep going up anyway. It seems a bit irrational at this point, but we're wondering, is there a setup that's going on here to kind of suck a lot of people into the market to help it go higher before it starts to go lower? We're not, other than pure speculation, we don't know that at this point. We'll just be able to watch it as it unfolds. And we'll get another read on inflation in Thursday and Friday session with CPI and PPI coming out. But interest rates, as I said, are going back up. Things are still pretty intense right now in the Middle East, but oil is continuing to come down a little bit now. And so we want to just keep an eye on that to see if there's more of an escalation that has an impact on the markets. Okay. Both the Dow and the S&P did set new all-time highs in Wednesday's session. The 10-year is still above that 4% level and even ticked up a little bit more in Wednesday's session. But what drove the indexes higher were mega caps and the semiconductors. And there were no real surprises from the meeting minutes that came out. Seems like inflation is under control and they're keeping an eye on employment, which is kind of what I've been trying to point out in the videos. It's employment that we're really watching. But so far, that seems to be holding up. We are going to get weekly jobless claims and continuing claims in Thursday's session as well. We'll see if that has an impact. And then we're keeping an eye on what's happening in the Middle East. We're down to $72 now with oil, where it had spiked up to 77. And then Hurricane Milton, I checked right before I started recording. Apparently, that's down to a category 2 now, which is still a pretty intense storm. But while it was still brewing and getting ready to hit from the Gulf of Mexico, it was a category 5. But once those things hit land, they tend to at least calm down a bit. But still, it's a very intense situation there. On a short-term basis, we are extreme with the Williams percent R. We have two new additions on the list, the CCI 14 and 20, as well as the stochastics. And we're also still looking extreme with the PMO studies, which could be taken as positive. It just means a lot of the stocks inside the S&P are still looking positive as measured by the price momentum oscillator. The Sean trend meter, the bullish percent index, which did not go up on Wednesday, even though we set an all-time high with the S&P. It's a little bit of a negative divergence there, and I'll show you that chart. We're a little bit more longer term, intermediate to somewhat a little bit long term with the 10-day new highs, new lows for the S&P. That's still looking extreme positive, which could also suggest that the market is holding up. And then long term, we're still looking rather extreme with the 150 and 200-day simple moving averages. No changes yet to the overall scenario. It seems like the soft landing scenario is still viable. And so that's what the market is going with for the time being. The dollar was up and interest rates were up. We're at 4.06% with the 10-year yield, where we had been at 4.03%. And we're still inverted with the 10 to the 3 month. The 10 to the 2 is no longer inverted, but it's coming back down a little bit. We'll have to see if something happens there where it goes inverted again. It's getting close, but not there yet. We didn't really change as far as sentiment. We might have seen some extra hedging going on ahead of CPI coming out on Thursday, where we're at 72. So we're positive and we're still below that 75 level. But to have an up day like we saw and to set an all-time high, we didn't change as far as sentiment is concerned. We are looking a little bit better with the trend, though. We're crossing back above the moving average. So now we have a strengthening trend that is positive because the green line is on top and we're still above 20. And with the up day, our bias is positive. And now I've changed our momentum from mixed to positive because we were in just a choppy sideways trend there for a while. We have broken out a bit to the upside, but there's still some warning signs that we want to pay attention to until they get dealt with and are not looking to make the market a little bit more vulnerable right now. So we did have the weekly MBA mortgage applications index. It was down 5.1%. We're seeing a rise in interest rates again, and mortgage rates are going back up. So folks aren't either getting a new mortgage or refinancing right now, where last week it was down 1.3%. Wholesale inventories, they came in up 0.1%. They expected them to be up 0.2%, which is what we saw last time. So here is the chart of the mortgage applications, where we've seen 2 negative weeks now as interest rates have been going back up. And we are still positive here with wholesale inventories, but it did drop down from the latest or from the previous reading here. So looking at the real investment advice, they post this every so often here, where it just says that the earnings estimates are well ahead of economic realities. We're still seeing projections going up, and that's what the stock market works off of. The problem is going to be is they start to lower these projections with earnings going forward, that could really put some pressure on the stock market. And then this bull market might be too, means we actually bottomed in October of 2022. And even though it's 2 years old, it's still considered young. Here's some bull markets going back to 1950, where the average is 5.5 years. The median is 5 years. So we're not even halfway through it, at least yet. And we do see really good returns. Here's the average return at 180% and the median return almost 108%. So for right now, things seem to be good, but we still have not really seen any kind of a decline, especially with some of the warning signs that have been on the sidelines. And they'll just stay on the sidelines until we actually see them follow through based on price. Then we're looking at the 10 to the 2-year yield, and just this is historic going back to 1950. And when different things have happened, where we no longer were inverted, and then eventually we end up going into a recession. And yeah, that's historically what will happen. But right now, the market is anticipating that going into a recession is what will not happen. And then both the Magnificent Seven and the other stocks in the S&P, their earnings are expected to slow in the third quarter. So we're seeing a bit of a drop off here, where the dark blue, that's a Magnificent Seven, and then these are all the other stocks. Still positive as far as their earnings, but on a year-over-year basis, but really dropping down from what we had been seeing. And buyback by corporate clients as a percent of the S&P 500 market cap, they're at an all-time high. So we're seeing a lot of buybacks, and that tends to really help the market and give it support and be seen as positive. The risk appetite is still below zero right now, but is showing an improvement as far as folks are still thinking that we're going to have a decline, but not as much of a decline as they had been anticipating in the previous survey that we saw here. Real estate positioning, and because of interest rates going back up, this might see some money coming out of it. But as interest rates were going down, that was really helping the real estate area of the market. And then these are different sectors. We're seeing an awful lot of money still going into ETFs right now, and with money going into discretionary. And that's one of the growth areas. We like to see that. We want to see more of that. And communication, that's another growth area. And we have tech, where money had been really coming out. Now it's starting to go back in. So actually, am I reading that the right way? Last week it was out, but the 4-week average is still positive right there. And we're seeing that helping the S&P 500, at least so far this week, where it's the mega caps and the semiconductors that are really helping the index to hold up for right now. But the rest of the S&P is also hanging together fairly well. It's not really seeing much of a decline currently. Then the largest inflow in equity, or excuse me, emerging markets right now, folks are starting to gravitate over to those areas of the market to see if they can gain some good opportunities there. Non-farm payroll growth in the thousands. In the month that the Fed starts easing policy, here we are. We still see positive growth, at least historically, when you measure this. And I did find a couple of charts. Now, this could actually be kind of negative for the market. It says Wall Street's most bearish firm, which is JP Morgan, says there's a chance of an upswing. Uh-oh. Could that be the nail in the coffin that really starts pushing prices down? And then commercial bank credit card assessed interest. And this is what can really start to hurt folks, is when they're having to live off of credit cards or use their credit cards more. The interest rate is just astronomical right now. And that just kind of feeds into itself. And to see this really going up, this is more of the real economy that's going on instead of the stock market economy that we see. All right, let's look at the intraday chart. Not much of a change. There wasn't a gap really at the open, but we just saw an up move that went above R1. We got above R2, and we were able to stay right around this R2 level with a bit more of an upswing going into the close. And we're pretty much flat right now in the initial overnight session. Things might stay kind of calm. We'll see if things in Europe end up driving the futures prices up or down, but with CPI coming out, it wouldn't be surprising to see the futures not really change all that much. And we are looking a little better here with the blue line above the red line. We're seeing growth coming in and showing an improvement on the intraday charts when we compare it to value. And we're still seeing a more or less upward trend here that we've started at the beginning of October, with growth outperforming value intraday for the S&P, even though it didn't perform all that overwhelmingly well in Wednesday's session. So our end of day charts were pretty much even. Growth and value were both up. They were pretty much even here with the mid caps, and growth was up a lot less for the small caps than value. But we saw a bit of an improvement here with our small cap growth to value ratio, but still in a downtrend. Another slight improvement here with mid-cap growth to value, but still in a downtrend and starting to break out a little bit. This is encouraging when we look at S&P growth to value. That's what we want to see in a more positive environment. And we're still showing an improvement here when we look at our growth versus value ETFs, but we're right in the middle of the rainbow currently. This is encouraging when we look at discretionary to staples. And it's not that discretionary is really breaking out and doing all that well. We're seeing some weakness in staples, and that's what's causing this ratio to go up. Large cap growth is still looking pretty good, but not setting an all-time high as the S&P did. We are looking a little better with our trend. We're starting to turn up above the moving average. So that suggests a strengthening trend. We're also above 20, so we are in a trending environment, and the green line is on top and going up. So that's showing an improvement there. We're also seeing an improvement with our short-term ADX chart as well, but we're still below average with volume. And then we did get the latest reading of Investors Intelligence, still pretty much neutral with their latest reading here. And we did decline with the VIX, but we're still above 20. And this is one of the warning signs that I've seen over the last couple of days, where when we're above 20 with the VIX, that's when we see negative annualized returns. So we did drop, but we're still above 20, both with the line chart and the bar chart. Also, we're coming down. Actually, we went up just a little bit here with the VIX of the VIX, showing that there's still some fear in the VIX being measured. This is another thing that I pointed out yesterday. We're still seeing it now. The correlation between the VIX and the S&P, we're even further above this dashed line right now. And this means the market could be getting nervous. Are we getting set up for some kind of a decline? Didn't happen on Wednesday. We'll see if it happens on Thursday. And here is the historical chart of the VIX, where we're in that time now where typically we see the VIX going higher. The momentum of the VIX also continues to be up. That's more of a warning sign too. And we're still up in this red area with the skew index, which is a variation of the VIX. This is that the market is anticipating some kind of a big move. And the fact that we did go up here and we're still getting a high reading, it might mean it's kind of hard to read this sometimes, but it might mean that the big move that's expected when we use it with other charts is still to the downside. But that could all fly out the window if CPI comes in friendly and the market just continues to go up. We declined with this one fear gauge that we follow. We were also really down here with this other fear gauge. So we are seeing some confirmation there, but the VIX itself is still quite high as some of these other fear gauges are really starting to drop. We went up with our risk on to risk off ratio, and that's what you would expect on an up day, pretty much led by the mega caps and the semiconductors. And we did see an increase here with the equity put call ratio daily chart. Again, some hedging, possibly ahead of CPI. And we're starting to go back up here with the 5-day chart, and we're turning back up with the 10-day chart. The volatility risk premium did come down just a little bit, but it's still giving us quite a high reading, showing that there's some perceived risk in the market right now. Okay, trying to change the slide here. All right, so looking at our advanced decline line studies, little bit of a negative divergence here because we went up with the advanced decline line based on price, set a new high with the S&P, but we did not break out with a new high based on price. However, on the positive side, we are setting a new high with the advanced decline line based on volume. We did see an expansion of the new highs, but we're still going flat with the sideways, and we're starting to bottom out, or at least flatten out a little bit with our 10-day average. But this is still looking pretty healthy internally for the S&P. We are still looking positive here with accumulation distribution. The warning sign is that we're below average with volume, but the boom indicator's kind of getting a little bit far away here, showing that the accumulation distribution may be getting overextended to the upside. We're still looking positive with our short and intermediate term advanced decline ratio. We're above zero based on price and volume with the advanced decline ratio. Now, this is also kind of a concern to set an all-time high with the S&P 500, but we declined with the Chaikin money flow, and the red line's starting to come down. So this all-time high is not being confirmed by the Chaikin money flow, but we're still going up with the Chaikin oscillator. And we're looking okay here with the vortex. And we look at the cumulative advanced decline line for the S&P based on price, not setting an all-time high here, but we are setting a new all-time high based on volume, and that could be taken as positive. And seeing a little bit of a disconnect here with the S&P going up and setting a new all-time high. We did turn up with the NYSE advanced decline line. They're getting a little far apart from each other right now, but they are on different scales. So the new highs, new lows are positive for the S&P, but we're still ticking down just slightly with the 50-period moving average. We can see that a little bit better here, where we're still coming down overall. Not a big warning sign, but just something we want to be aware of. The positive side of this is that we're still above zero with this indicator. The 10-day average also still giving us a very high reading. That's also positive for the S&P. We are breaking out with the cumulative advanced decline line for the NYSE based on how this is measured and breaking out above the previous high, but we really didn't see much follow through with the regular NYSE advanced decline line. And a little bit of a tick up here with our other NYSE advanced decline line. So this was mainly the mega caps and the semiconductors that led things higher on Wednesday. And we see that here, just a little bit of a tick up with the advanced decline line for the common stock on the NYSE. A little bit better improvement, but not a new high with the NYSE common stock based on volume. We are still above zero with the new highs, new lows on the NYSE. We look at the broad market 5-day moving average, also still above zero. That's positive. And then we look at the 50-day moving average of the new highs, new lows, still coming down just slightly here. The advanced decline line looking good, but not setting a new high with the NYSE common stock. Not a new high yet with the S&P. Turning back up slightly with the mid caps and bouncing off the moving average again with the small caps. The ratio between large caps and small caps did show an improvement. We're seeing a little bit of a breakout here, but when you take all of this together, we've been really pretty choppy. We are looking a little bit better with those stocks in the S&P above their 20-period moving average, 50-day moving average, 100-day moving average, and 200-day moving average. And the concern here is that we're still below average with volume. Looking a little better with the 20, 50, and 200-day moving average study on the S&P. Crossing above the midpoint with the Stochk RSI. Extreme positive with the Williams percent R showing good momentum. The CCI 14 is extreme, and the CCI 20 is also extreme, which could be showing good momentum. The condition of the 20-period moving average, we were able to come back above the green line and the blue line now, though. So that's showing some improvement, and we're still above the simple and exponential 20-day moving average here. We never did drop below that. So the short-term trend is still positive there. We're extreme in the short term with the stochastics going up, but not extreme in the intermediate term, starting to turn back up, but still extreme positive with the long short-term stochastics. The force index is still looking a little more positive now, and we're going into the +2 channel with our standard deviations chart. So that is positive as well. We've crossed back over positive with the balance of power. So intermediate term, that is showing some improvement there. We're above both the red line and the blue line with the condition of our 50-day moving average. And we're positive with the dark blue bars with the go, no-go system. We're coming up and setting a new high with the highest high value chart. That's positive. But the TTM squeeze is still continuing to decline with the darker blue bars. And we're pretty much flat with the ease of movement, but we're still above zero, so we're positive there. We did see a little bit of life coming from the Erin, which is looking more positive now with the oscillator. And we're still negative here with the S&P McClellan oscillator. We did bounce back up, but we're still below zero. So we are continuing to decline based on price, but this could be positive. We're starting to turn back up based on volume. Right now, this is a divergence. We're not sure if this is leading for a price to actually go higher or if this is going to end up being a false signal. We have to ultimately see follow through based on price, one way or the other. We're also showing some improvement here with the NYSE McClellan oscillator, but we're still below zero. So we're declining with the summation index based on price and volume. We're looking a little bit better with the Swenlin trading oscillator based on price, but we're still negative, where we bounced off the zero line and we're positive based on volume. Momentum still having a little bit of trouble here. The PMO is pretty much on top of its moving average. We're still declining based on price, still slightly negative based on volume. Saw a little bit of an improvement with the PMOs that are rising, starting to turn back up with the buy signals. And this is the extreme reading for the rest of the S&P that I pointed out here. It just shows that most of the stocks, 82% of the stocks in the S&P 500 are still positive with their PMO readings. And we continue to be positive with the Elders Impulse system for the S&P. We've switched back to positive with the parabolic SAR. So this is a primary indicator for me. This is leaning things a little bit more positive now. We'll see if it's able to stay that way. The slope oscillator is no longer extreme. We're dropping down below the green line, but we're still declining here. So that's more negative. And we're trying to turn back up with the MACD, but we haven't crossed back above the moving average yet. So we're still negative in the short term, trying to turn back up with the TSI, getting some mixed signals there. The MACD is trying to turn back positive. The PMO is bouncing off of its moving average, looking a little bit better with the PPO, still right on top of the moving average with the TRIX and the KST. And we're still negative with the Copic curve as far as momentum. We're still extreme with the Sean trend meter. We're still above all the plotted moving averages. Now, this is another warning sign here. Setting an all-time high with the S&P, actually declining slightly with the bullish percent index, not breaking out necessarily. But we're still looking pretty good here with the NYSE bullish percent index and some more improvement with the NASDAQ 100 bullish percent index. Declined a little bit, but still above 50 with the money flow. Declined also, but above 50 with the ultimate oscillator. And with the up day, we saw on balance volume finally break out of this range above an advancing moving average. We're above 50 with the RSI and the RSI 9, both based on 14 and 9 periods. So that's short and intermediate terms, still looking positive. The weekly chart of the S&P setting a new all-time high. That's positive when you look at things based on the chart. And we're turning back more positive with the Heiken Ashi with the open candles. We are positive with the Kagi chart. We never did turn negative with the Renko chart, and we're showing an improvement here with the 3-line break chart. Long term, still looking good and well above these red lines here with the 150 and 200-day moving averages. We're still negative in the short term with the small caps, but all of the other time frames and all of the other indexes are positive. Bonds are still negative based on price in the short term, where we're still negative in the long term with commodities, and the dollar is still in a downtrend in the intermediate and long term. And the only sector that was down were utilities, where all the other sectors were up, led by technology, that's growth, discretionary, another growth area as well. Communication barely changed. It would have been more helpful if communication had done better. And everything that was generated for the alerts ended up being positive, with the NASDAQ going above 18.2 and then 18.3. Canada set an all-time high, and the S&P set an all-time high. And still looking pretty good here between the S&P weighted, which is going up a little bit more since it was the big stocks that drove the index higher, but not really a disconnect yet when compared to the equal weight index. Not much of a change here with the ratio between the weighted and equal weighted version of the S&P. The Dow is setting a new closing all-time high here. We're positive with the Elders Impulse system for the diamonds, not setting an all-time high with the NASDAQ, but it was up 0.6%. The NASDAQ 100 was also up 0.8%. And we're positive with the Elders Impulse system for the Qs. The momentum is starting to turn back positive here as measured by the PPO for the NASDAQ 100. It's coming back above the moving average. Small caps up 1/3%, still above this pivot point, still above its 50-day moving average. We're positive after being negative with the small caps when measured by the Elders Impulse system. Then we look at the Russell 2000 small caps, a little bit above 50 with the RSI, still above the 50-day moving average, but the momentum, as measured by the MACD, is still negative. And we're just chopping along sideways with the mid caps, but we continue to be, or actually we've switched to positive with the mid caps with the Elders Impulse system after having been neutral. The Wilshire set a new all-time high. That's a broad market measure there. We also have the total U.S. stock ETF setting a new all-time high. The staples to tech ratio continues to go down. That's more positive for the tech sector, but we're concerned about this recent golden cross showing that staples are in an uptrend when compared to tech with this ratio. The financial sector still looking good. I believe that is a new all-time high there. The FANG index was up 0.88%, but still has a ways to go back to its all-time high. And we're still above this longer-term trend line, but we've not been able to get above this shorter-term trend line with the FANG index. And Apple was up 1.67%, looking pretty solid above its 50-day moving average. Amazon was up 1.33%. Microsoft, we're watching to see if there's going to be a death cross here. It was up 0.66%. And Google came down to its 200-day moving average. That was down on 1.5% right there. There's some similar to the late 90s with Microsoft when the government came in and you're too successful. We have to break you up. They're kind of doing that same thing with Google right now, whether you agree or disagree with that. And it'll probably break them into different companies, but really ultimately not have much of an impact. Meta looking still really good here, even though it was down 0.4%. Nvidia was down slightly above its 50-day moving average. Tesla was down 1.41%, still above its 50-day moving average. Netflix was up 0.79%, and it's looking like this is a new all-time high here. And we're still seeing a bit of a weakening here when we look at US stocks versus world stocks, which kind of goes against what we're seeing here. We have the S&P going up in red and then the world index going down. Well, part of that world index is emerging markets. And so the fact that this relationship is trailing off a bit here is a bit of a concern, but longer term, the relationship is still intact. Oil continues to drop down back into the mid 70s now after it had gone up to 77. We're watching that for geopolitical reasons. The dollar is still in a downtrend, but still bouncing up after coming down to the 102 level. And we're still going up with the 10-year yield. We're a little bit further above 4% now. So based on price, the 7 to 10-year bond ETF is declining. And seeing a little bit of an improvement here with Qs to the S&P, but not really discretionary to the S&P. Now, when we compare discretionary to staples, it's looking pretty good. But when we look at discretionary to the S&P, it's starting to fall underneath its moving average. Seeing a bit of an improvement here when we look at large cap growth versus large cap value. So the large caps are above their moving average. Mid caps showed some improvement, and small caps did too. The question here is, will we see follow through? And we're coming back up a little bit with the S&P to utilities ratio, but overall this has been declining, which is more negative for the S&P. This is positive for the S&P. The staples to S&P ratio continues to decline. And then just an update of the chart. Really nothing to show you other than the date has changed here with the Hindenburg almond. Just wondering if that's going to eventually turn into something there. So what's our outlook for Thursday? We are still positive. We still have this confirmed Hindenburg almond and weak seasonality historically. And we're still seeing these VIX signals that are giving us some concern. Didn't seem to matter on Wednesday. We'll see if they matter on Thursday. We're going to get weekly jobless claims and CPI. Those are two pretty big reports that'll be coming out. And then the geopolitical things, specifically what's going on in the Middle East, and then what's happening with the hurricanes that has already hit and the new hurricane that is now hitting. Is that going to be some kind of a major event as well? And then here's the economic calendar showing that on Friday we will get PPI and consumer sentiment. And here is a look at the previous reading and the forecast that they are expecting. Seasonality, we're neutral to negative with the Dow and S&P. We're neutral to positive with the NASDAQ. So really no edge either way there. We're on the 8th trading day of the month where we do see a little bit of negative seasonality here before we get a day or two of positive seasonality during an election year. Thursday tends to be more positive based on 2023. Thursday is the most positive day based on 2024. And here is this seasonality that just does not seem to really be playing out, at least yet. So we are still watching this confirmed Hindenburg almond and weak seasonality, which to this point has been irrelevant, but that could always change. About the time you write off something like this is when it kicks into gear. We are watching the more defensive areas of the market like staples, utilities, and healthcare. And we're keeping an eye on growth of value, which is improving now for the S&P, but we want to see more follow through. Discretionary to staples looking good, but when you compare discretionary to the S&P, not really showing much of an improvement there. And we're watching these multiple VIX signals that are flashing right now, which they could be positive, but typically when we see them the way we're seeing them right now, they end up being negative if they're even relevant. And we're still negative with the S&P and NYSE McClellan oscillators and summation indexes. We're seeing a divergence with the Swenlin trading oscillator. We're positive based on volume, which could be positive in and of itself, but we are negative based on price. And our oscillator showing some improvement here, but still looking negative overall. And then the positive signs, seeing a little bit of weakness with accumulation distribution and Chaikin money flow in the Chaikin oscillator, but they're still positive for right now. And the 5-day and 10-day equity put call ratio they're both going down, which tends to be positive. The advanced decline line looking pretty good. We're still extreme with the bullish percent index for the S&P. The NASDAQ 100 is improving, and the NYSE is still looking pretty solid there. Parabolic SAR is now back to positive. The vortex is positive. The money flow, ease of movement, and ultimate oscillator are positive, as well as looking a little better with the momentum for the NASDAQ 100. The financial sector is still looking pretty solid there. So our conclusion, we're positive, but we have this crazy Hindenburg omen in the background that at some point may matter. We also have weak seasonality that just has not happened yet, and we're watching these VIX signals. In the short term, a little bit overbought now, but that could also be suggested as good, solid upward momentum. And we are still positive in the intermediate term. This is where we're watching more of the VIX signals right now, but we are still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.